It's official. The new law is signed and ready to roll out. Except, it's not exactly what was promised. Many Americans were hoping for more relief when it came to Social Security tax. But the new law does include a few little-known items that will save you money. Some will last only a few years, while others are now cemented permanently. So what should you do right now to take full advantage of these changes before it's too late? Let's dive in and find out together. The first thing you need to know is how the new law keeps more of your money. You might have heard that the current tax rates are supposed to expire in 2025. Well, the new bill changes that. There are now 7 income brackets, and none of them are going anywhere, at least for now. 5 of them were due for a jump in 2026, but the bill makes those increases disappear. Take a look. In 2025, the lowest tax bracket starts at $15,400 for single filers. But in 2026, it was slated to rise to $18,950. Instead, thanks to the new law, it stays at $15,400. And that's great news, because it means your chances of getting a tax cut have gone up. And let's face it, we could all use a little extra spending money in our pockets. Now let's look at the other end of the spectrum. In 2025, the highest tax bracket kicks in at $575,000 for those filing jointly. Come 2026, that threshold was poised to climb to $665,000. But guess what? Thanks to this new legislation, it stays put. To sum it up, the tax brackets we all know and love are sticking around, and that means we won't see any immediate changes in our tax rates. Congratulations, you just dodged a bullet. But it gets even better. Let's talk about those pesky tax brackets for single filers. Let's switch gears and tackle everyone's favorite topic, taxes on Social Security benefits. Most people thought this was going to change, but surprise, surprise, it didn't. Still, there's a silver lining. Remember the senior bonus deduction we talked about earlier? It's coming in hot at $6,000 for individuals and $12,000 for couples. Here's the catch. This deduction only sticks around until 2028. That's only 3 years. But hey, every little bit counts, right? The best part, it doesn't matter if you choose the standard deduction or itemized deductions. You can still snag this sweet bonus deduction on top. Here's a quick refresher on how it works. You get the deduction whether you file as a single individual or as a married couple. If you're looking to reduce your tax bill and qualify for the deduction, your income needs to stay below certain limits. As a married couple, you'll receive the full deduction if your income is $150,000 or less. However, if your income exceeds $250,000, you won't be eligible for the deduction. To illustrate how this can work for you, let's consider a few examples. If you're single and 65 or older with an income of $125,000, you can deduct $6,000 from your adjusted gross income, effectively lowering your taxable income by $6,000. On the other hand, if you're a couple aged 65 or older with an income of $225,000, you'd enjoy a $12,000 deduction. That's enough to push many retirees out of a higher tax bracket and potentially avoid paying taxes on their Social Security benefits. There's also good news for those who still owe taxes on their Social Security benefits. This deduction can help reduce that amount. For instance, if you're a single senior with an income of $75,000 and owe taxes on $15,000 for your Social Security benefits, you could potentially write off the entire $15,000 against. It's a $6,000 deduction. Moving on, the bill introduces something known as the Saver's Credit, which aims to boost savings among working folks. Unlike traditional retirement plans, you don't need an employer to participate. This credit offers a generous 50% return on your retirement contributions up to $1,000 for individuals and $2,000 for couples. But remember, you must be under 50. If you're over 50, you can still claim the Saver's Credit, but the maximum contribution limit jumps to $2,500 for individuals and $5,000 for couples. And here's the kicker. When you're between the ages of 65 and 70, you can't claim the Saver's Credit anymore. But fear not, there's a solution. You can turn to your spouse if they meet the age requirement and make contributions to their IRA, or if you're still working. You can start contributing to a workplace retirement plan like a 401k or 403b. But here's a warning, this opportunity won't last forever. It's only available for those who make less than $120,000 a year. so it's crucial to seize it quickly. Now let's talk about some major wins for homeowners. Just like last year, you can still deduct up to $750,000 of mortgage interest if you bought your home before December 15, 2017. But there's more. For those of you who paid mortgage interest last year, you've got a nice surprise waiting. You can say goodbye to the SALT deduction caps. In simple terms, this means you can now deduct property taxes and mortgage interest payments without worrying about the $10,000 limit. But this doesn't mean you can deduct unlimited amounts. Your total state and local tax deductions, including sales taxes, are capped at $40,000. This change is set to stick around until 2029. After that, the $10,000 cap comes back into play, unless Congress steps in again. Another big win is for homeowners age 65 and over who own homes with a fair market value exceeding $1 million. They can now exclude a whopping $650,000 from their taxable income. But remember, this benefit is temporary and set to expire in 2028. For those thinking about gifting money to loved ones, the bill brings a nice bonus. Unmarried individuals can gift up to $30,000 per recipient without worrying about gift tax. Married couples filing jointly can gift up to $60,000 per recipient and still not pay any gift tax. Previously, the annual gift tax exclusion stood at $17,000 per recipient. This change ensures that fewer families need to file complicated gift tax returns. One of the more controversial aspects of the bill concerns the estate tax exemption, which was initially set to drop significantly. The good news is that the bill removes this drop, ensuring that exemptions remain high. Currently, the exemption stands at $12.92 million for individuals and $25.84 million for married couples. Till the exemption expires, you can transfer these amounts to heirs without any estate tax. However, remember that it's set to expire in 2028. That's all for today, folks. We'll keep you posted on any changes or updates. See you in the next video.